Welcome to the Deep Dive, your shortcut to being well-informed on the latest earnings calls. Today, we're plunging into MetLife's second quarter 2025 results. That's MFIC on the market. And break down the numbers, unpack management's strategic insights, and really give you the context you need to understand what's moving the needle for this insurance giant.
Yeah, it was quite a quarter. It really showcased MetLife's resilience, I think, in what's a pretty dynamic economic environment. And layered on top of that, some genuinely compelling strategic moves management's making. We'll look at where they delivered, where there were some, challenges, and crucially, what management seems to be signaling for the rest of the year and beyond.
Okay, let's kick things off with those headline numbers, the ones that caught everyone's eye. MetLife reported non-GAAP earnings per share of $0.39. So that's a strong beat, right?
Yeah.
Handily surpassing consensus estimates by about 5%.
Exactly. And that non-GAAP figure, it often gives a clearer picture, of the core operational performance. It excludes those one-off items.
Right, the underlying business. For the full accounting picture, though, their GAAP EPS came in lower at 219 cents. Total investment income, essentially the revenue here was $81.25 million. A slight miss against consensus, but still up a robust 17.5% year over year. That's pretty impressive growth.
It really is. And digging a bit deeper, we saw net asset value per share dip slightly, about 1.2% sequentially to $14.75. That's something to maybe keep an eye on. But net investment income still posted a solid $36.4 million.
Okay.
And MetLife's adjusted return on equity, it reached 14.6%, very close to their mid-teen target. And that's even after absorbing some lower variable investment income. Shows some underlying strength there.
Definitely. And they're returning capital, too.
Oh, yeah. Actively managing capital. They returned about $900 million to shareholders. That's through dividends and share repurchases just in the quarter. A significant commitment.
And the market reacted positively, right? I saw the stock ticked up after the call.
It did. Suggests investors appreciated the underlying story, maybe looked past the mixed signals on the surface, focused on the execution and the strategy.
Okay, so headline numbers covered. Now let's peel back the layers, really get into what drove the Q2 performance, both the good stuff and the areas needing attention. Let's start with that overall adjusted earnings figure, $1.4 billion, or 22 tourism per share. Now that was down 16% year over year. That's a pretty significant swing. What were the key drivers behind that dip, and how's management looking to address it?
Yeah, you're right. That 16% does stand out. The decrease was primarily due to less favorable underwriting and also lower investment margins compared to the prior year.
Less favorable underwriting, basically higher or more severe claims than expected.
Essentially, yeah. Relative to the premiums they collected. Suggests maybe the models were a bit off, or perhaps just an unlucky quarter for claims. But it wasn't all negative. This was partly offset by strong volume growth and, impressively, very favorable expense margins. Their direct expense ratio was 11.7%.
Oh, wow. That's well below their target, isn't it?
It is, yeah. The annual target's 12.1%, so that efficiency is a real, silver lining. Management's really banking on their new frontier growth strategy to navigate this. It's a big plan. Responsible growth, attractive returns, but with lower risk, and leveraging that convergence of insurance and asset management, finding new revenue, new efficiencies.
That new frontier strategy sounds ambitious, almost like a reboot. Is it genuinely fresh? Or more like refining existing tactics? Because hitting that lower expense ratio is great, but a 16% earnings dip needs a strong response.
I'd say it's more than just refinement. It feels like a strategic pivot. Three main pillars, like I said: responsible growth, attractive returns with lower risk, and capitalizing on those blurring lines between insurance and asset management.
Trying to be more of a full-service financial partner.
Exactly. Not just selling policies, looking for synergies between their huge investment portfolio and their insurance side. The challenge, of course, is executing this without weakening their core insurance strengths, especially with those underwriting results. It's a balancing act, but the expense management shows they're disciplined within that new framework.
Okay, let's dive into the individual segments then, because the overall picture is mixed, but the details tell a deeper story. Group benefits, for instance. Adjusted earnings were $400 million. That's a 25% drop from what was a record quarter last year. A really pronounced shift. What's the read there?
Yeah, that's crucial. A 25% drop from a record definitely raises an eyebrow. The main driver was that less favorable underwriting again, particularly life and non-medical health products. They specifically mentioned elevated individual product experiences and a small number of large disability claims.
Okay, so specific issues. But management sounds confident.
They do. They were quick to say they don't see it as a systemic trend. They're actually quite optimistic. They expect a 200 basis point improvement in the non-medical health ratio for Q3 and another 200 basis points in Q4.
Basis points, so 2% improvement each quarter.
Exactly. They attribute it to a return to normal seasonal patterns for dental and stable disability trends overall. On the plus side, sales year to date were up a healthy 9%, driven by regional business, and they expanded that strategic partnership with Workday for their Upwise benefits platform.
The Workday partnership. That sounds significant.
Yeah.
Embedding their offerings directly.
Right, into HR and benefit systems.
Yeah.
Streamlines access, potentially expands reach massively.
Okay, management sounds confident these are isolated incidents, maybe seasonality, but a 25% drop from a record high. It's not trivial. Are there any indicators this could be more than just a blip? What metrics would you watch closely?
That's a fair challenge. Seasonality plays a role, sure, but the size of the drop warrants scrutiny. I'd be watching the detailed claims data closely next few quarters, looking for any lingering trends in frequency or severity beyond what's typical for dental and disability, and how quickly those non-medical health ratios actually improve. That's critical.
Well, it's like those 200 basis points don't show up.
Exactly. It might signal deeper issues in risk selection or pricing. The sales growth and Workday deal are positive, yeah. Shows they're expanding, but profitable growth is the name of the game.
Okay, shifting gears. Let's look at retirement and income solutions. RAIs, adjusted earnings there, $368 million, down 10% year over year. What's the story?
For array-Is, the decrease was mostly lower recurring interest margins. That can happen as older interest rate caps mature, and assets reset to current, maybe lower rates. But it's not all bad. Investment spreads held at a healthy 102 basis points.
And that spread is key, right? Shows they're earning more on investments than paying out.
Absolutely. A crucial metric. Shows good investment management in this rate environment. And what's really fascinating here is the launch of Chariot 3 in July. This is a big one. A $10 billion reinsurance deal with General Atlantic, initially focused on MetLife originated liabilities.
Okay, $10 billion reinsurance. So they're transferring risks.
Sort of. It might temporarily lower their liability exposures on the books, but strategically it's designed to be accretive to earnings because the excess capital freed up gets redeployed into higher returning assets.
Freeing up capital. Smart.
Very. We also learned about their robust funding agreement-backed note business, FABNs. These are basically bonds insurers issue for long-term funding. Accounts for about 10% of their general account liabilities. They consistently issue $6 to $8 billion a year.
Wow, a stable funding source.
Significant and stable, yeah. They even mentioned that overall market growth in FABNs is actually good for them.
That Chariot 3 deal, the FABN business, it paints a picture of really sophisticated capital management. This isn't just selling policies, it's optimizing the whole balance sheet. Is this a model they plan to replicate? Keep freeing up capital with deals like Chariot 3.
Absolutely. It's proactive shaping of their future capital structure. Chariot 3 lets them de-risk specific business blocks and free up capital for reinvestment. That redeployment is key to driving higher earnings later. It's a very attractive model. Wouldn't surprise me to see similar, maybe smaller deals going forward as they optimize. Ties right back to that attractive returns with lower risk pillar of the New Frontier strategy.
Okay, let's go international now, starting with Asia. Adjusted earnings. Yeah. $350 million, down 22% on a constant currency basis. What happened there?
The earnings drop in Asia was mainly, again, less favorable investment and underwriting margins. Similar theme. But the underlying story isn't all bad. Sales, constant currency, were actually very strong, up 9% across the region. Japan surged 29%, and Korea 36%.
Wow. What drove that growth?
Successful new product launches, distribution expansion. And here's an interesting currency dynamic. A strengthening yen is driving lower policy surrenders.
Lower surrenders. People holding on to policies. That sounds good long term.
Exactly. It might create a short-term earnings headwind because of currency translation, but it's a very positive long-term signal. Supports future sales, AUM growth. The underlying business is performing well, even if reported earnings are hit short-term. Management actually expects Asia sales to be at the top end of guidance for the year. Strong momentum.
Okay, now Latin America. That segment really bucked the trend, didn't it? Posted an all-time quarterly high, $233 million adjusted earnings, up 15% constant currency. What's fueling that kind of consistent outperformance down there?
Latin America was definitely the star. It's a story of consistent execution. That 15% growth, matching an all-time high, fueled by strong volume growth and favorable returns. A big driver they highlighted is their Accelerator embedded insurance platform.
Accelerator, embedded insurance, so integrating insurance into other services.
Precisely. Reaching customers at the point of need. Since launch, it's serving 5 million customers. Generated over $300 million in premiums, fees, and other revenues, PFOs. Huge testament to digital distribution, meeting customers where they are, highly scalable, clearly paying off.
Impressive. And finally, EMIA, Europe, Middle East, Africa. Also strong.
Very strong. Near record adjusted earnings of $100 million. That's up a remarkable 30% constant currency.
30%. Wow.
Yeah, driven by strong volume and sales growth right across the region, robust demand, effective distribution. Management anticipates their quarterly run rate for EMIA will stay above guidance for the rest of 2025. High confidence there.
So a mixed bag globally.
Yeah.
Latin America and EMIA thriving. Asia navigating headwinds. Group benefits facing that dip. Zooming out, how does this all connect back to their broader strategy, especially that huge investment portfolio?
That's the perfect connection to make. It all comes back to capital allocation. MetLife's actively managing its portfolio. There's been this multi-year pivot towards first-lien, directly originated debt. Right now, 93% of the portfolio is first-lien, 99% floating rate exposure.
First lien meaning safest, highest priority if a borrower defaults.
Exactly. Lower risk. It's a disciplined approach in a competitive market, aiming for security, predictable income. And a key catalyst coming up, that anticipated $90 million repayment from Merx Aviation, probably in the September quarter.
Okay, $90 million. That's deportable cash.
Right. And it's expected to add about 0.06 cents per share to net investment income, a direct boost to future earnings. They're also exploring other strategic deals, the acquisition of PineBridge Investments, and a big variable annuity risk transfer deal with Talcott Financial Group, both expected to close second half of 25, all moves to optimize assets and risk.
These capital moves, the acquisitions, sound like a powerful reshaping of their profile. But how are they using tech to make it all happen? Especially AI. Is it real or just buzz?
That's critical, yeah. Strategy needs execution. And they are leaning into tech, viewing AI as a key enabler for that new frontier strategy. It's not just talk. They mentioned applications already in full production, things like programming, helping call centers, streamlining claims processing.
So real-world applications.
Yeah, it reflects a multi-year effort to modernize systems, improve data quality, make their huge data sets usable for AI. They're aiming for efficiency, better customer experience, better profitability, all supporting those target returns. It's about getting an edge.
Okay, so what does this mean for you, the investor? The direct lending sector, where MetLife operates, has tight spreads, resilient earnings. But rating agencies are flagging potential non-accrual creep as rates normalize. Can you unpack non-accrual creep?
Yeah.
And is MetLife maybe insulated?
Yeah, non-accrual creep, definitely a term to watch. It means a gradual rise in loans where interest isn't being paid or accrued anymore, signals worsening credit quality. As base rates normalize, some borrowers with older, cheaper debt might struggle, leads to non-accruals. So the question is, how's MetLife positioned?
Right.
They clearly see themselves as a carry story, selectively deploying capital, leaning heavily on that strong first-lien, directly originated book, emphasis on first-lien, prioritizing the safest part of the capital structure, gives them a buffer. Their net leverage, 1.44x, is right on target. And KBRA just affirmed their EVB rating with a positive outlook, reinforces funding stability.
So they feel well-positioned despite sector concerns.
That seems to be the message. While their total return has lagged the broader sector ETF like BIZD recently, their execution and strategy, focusing on lower risk, direct assets, aim for long-term value and stability, even if it means maybe sacrificing some aggressive short-term gains.
That distinction is important. So what are the key catalysts for the second half of 25? What should investors watch?
Good question. A few key things. First, the pace of M&A recovery generally. That impacts origination opportunities for their lending. Second, how efficiently they deploy that Merx Aviation cash, how quickly and well they reinvest that $90 million impacts NII. And third, potential CLO repricing or upsizing. CLOs are collateralized loan obligations. Adjusting terms or size matters. These factors will really shape performance, show how well they're executing.
All right, time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on today's deep dive. Remember, purely for entertainment, conceptual exploration.
Okay, given MetLife's strong first-lien floating rate book, that expected 0 to 6 cents per share NII bump from Merx Aviation, and management's optimism for H2 M&A and deals, Here's a thought.
We're going with a long MFIC call spread for early 2026. Picture this: buying slightly out of the money calls, betting that Merx capital gets redeployed faster, more efficiently than the market expects, coinciding with the surge in M&A that boosts originations and earnings. You could finance it by selling a higher strike call, caps the upside, but lowers the cost.
And to make it really spicy, maybe pair that with a short position on a broad direct lending sector ETF as a hedge.
Ooh, interesting hedge. Why?
The thinking is, MetLife is disciplined, focused on lower-risk first-lien loans, but the broader sector faces those tightening spreads, potential non-accrual creep rating agencies mentioned. So you're essentially betting on MetLife's execution, portfolio quality, maybe their AI investments, to outperform the general industry headwinds in a potentially tougher credit environment. It's a classic relative value play with some specific, idiosyncratic catalysts for MetLife.
Okay, there you have it. A comprehensive look at MetLife's Q2 2025 earnings call. We've covered the solid non-GAAP EPS beat, the strategic moves in the segments, and that promising outlook for capital redeployment and M&A, clearly a company actively positioning itself.
Indeed. They're navigating a complex market with that clear new frontier growth strategy. Disciplined capital management, targeted tech investments. Challenges remain in some areas, sure, but the momentum in places like Latin America. And those strategic transactions, they really position them for future growth. The question for you, the listener, is whether their calculated bet on AI and disciplined capital use will truly set them apart.
And remember, this deep dive is just for informational purposes. It is absolutely not financial advice. Always do your own research before making investment decisions.
We hope this gave you the clarity and insight you needed on MetLife's quarter. Thanks for joining us on the deep dive.
We look forward to bringing you more in-depth analysis on the next call. Until then, stay informed and keep learning.